Credit quality review, stress test. We've been talking about banks all year, but how ready and healthy are they to take on the real economy? I'm Maithreyi Seetharaman. On the show, we speak to the supervisor of the test, the European Banking Authority's Director of Oversight, Piers Haben, about the banking union and whether we're really now prepared for a future crisis. We'll travel to Italy, the worst performer in the test, to see the impact on the real economy. And we'll go back to the future to see what happens when expected and unexpected problems come true. The European Central Bank, now the supervisor of all Eurozone banks, conducted a test on Eurozone bank balance sheets at the same time as the EBA supervised EU-wide stress tests. Now, the idea to compare apples with apples. So for the first time, you could look at a German bank in the same way that you would a French or a Belgian one. The idea to see how strong the steps that they're taking towards the future are. So here's first a crash course on the stress tests.
Think of your bank as a bridge. When you're on it, you expect to be safe. That means it needs to be tested for strength, be it in a storm or a big disaster such as an earthquake. The foundations of that bridge, for a bank, its capital, must be strong enough to withstand anything that happens. 123 European banks were put through EBA-supervised stress tests, which were coordinated by competent authorities, or CAs. They checked for various potential future crises, such as a drop in economic output, an increase in unemployment, or a housing crash. Europe's banks had to show that the ratio between capital and risk wouldn't fall below 5.5%. For the test, banks had to submit their calculations to be checked by CAs. 24 banks didn't pass, but in the time between going through the tests and the publication of the results, most had increased their capital or cut back budgets. The 8 remaining banks now have less than 9 months to fill a €6.35 billion gap.
A loan book is a bank's biggest asset, and its value depends on the ability of a borrower to return the money and the value of the collateral used, so say a house for a mortgage. Now, many banks that thought they'd fail spent the last year raising money, but what popped up in the test was the amount of bad debt not confessed to, a rather huge amount. 4 Italian banks, led by Monte dei Paschi, landed up with the bulk of the capital raising bill. So Guillaume Desjardins trekked down to the city of the world's oldest bank, racked by many problems other than just the tests, to see the real economy impact of what the Italians now have to do.
The colourful markets between Rome and Siena provide a reminder that we all need money. And when in need, we turn to banks for a loan. Loan approval has been the biggest issue in the Eurozone crisis, and stress testing banks is supposed to get them lending again. Monte dei Paschi Bank was set up in Siena to lend money to the poor. In 2014, the bank was among the worst performers in the stress tests. So Siena joins the rest of Italy in figuring out how banks can work for the people once more.
On the long term, I think this will be a good impact because basically it's cleaning up. In the short term, banks that have been certified by the ECB will be more free to operate. But some banks that probably are on the borderline or have been, did not perform so well in the stress test, they will have to dismiss risky assets, and so they could reduce their lending in the near future.
Demand for credit from companies and households across Italy is expected to rise towards the end of the year. But this may result in the more cautious banks offering fewer loans.
Banks are essentially discouraged from giving risky credit. But at the same time, doing nothing can worsen the economic crisis, because the companies that may need more support are also the ones that banks view as a risk.
The European Central Bank was recently enlarged to incorporate the Eurozone banking regulator. This led some experts to believe that, as player and referee, the ECB would make sure there is enough money available for banks to keep lending.
Liquidity can help the supply side, but we also need a stimulus on the demand side. The problem is that without trust in the recovery, there will be no new investment cycle.
The way the ECB will decide to use its new tools will be decisive for Eurozone economies such as Italy. ECB Governor Mario Draghi has already alluded to the possibility of injecting fresh liquidity into banks. This would help them to raise their capital and avoid the potential dangers of stopping lending.
Our guest this week is Piers Haben. He is Director of Oversight at the European Banking Authority. Piers, let's start off with the Italians. What kind of lessons have been learned going into the future?
These are problems that we have seen in many countries across the EU. The first is lack of sufficient capital. That is the foundations of the bank. The second component is dealing with bad loans. Banks lend into the real economy. That's what we want them to do. But when the economy goes wrong, those loans go bad. And we need to make sure that they have sufficient liquidity. We need to make sure that they are in a position to deal with problem loans promptly. And we need to make sure that they can do their job of lending to households and companies across the European Union.
Do you think these kind of tests are going to make banks focus more on their capital ratios rather than lending into the real economy?
It is only banks which are well capitalised that are able to continue lending in good times and bad. We have already seen improved funding conditions in banks. There's an immediate impact that we have by instilling confidence in banks, allowing funding to come into banks and allowing them to lend now. We saw over 50 billion euros raised during 2014 just to identify the problems that may occur in the stress test.
We've got a banking union, but not without compromise. You've got bankers with LIBOR fixing right under the regulator's nose. What's going on there?
You've raised a number of issues there about banking. The first is, are we finished in terms of strengthening capital and liquidity? No, we still have some journey to go. The setting up of the single supervisory mechanism was almost unthinkable 2 or 3 years ago, and now it's happened. And you raised the issue about LIBOR fixing. Clearly, there are issues about banks' business models, about ethics in banks that need to be addressed, and it's absolutely key that supervisors and banks are working to address that.
Let's admit it, the tests have brought transparency to an economy that's heavily bank-based with deep links between European banks and their governments. And no one is arguing the need to be able to foresee situations where the taxpayer may just have to bail out big banks yet again. But the test did leave out 2 critical scenarios in its time frame till 2016, sovereign default and, more importantly, deflation. So what happens if banks come face to face with predicted and unpredicted situations? Gianni Magi went back to the future to find out.
A time machine has transported us to 2016. We're in Spain, where banks have performed quite well in the stress test, but the time machine has played a trick on us. We landed at a time when the worst-case scenario imagined by the stress test has really occurred.
So here's what's happening in 2016. Global bond yields are increasing, credit quality is deteriorating, structural reforms haven't yet been implemented thoroughly enough, and confidence in the sustainability of public finances is very low. A further complication is the stress the commercial housing sector is under, and a foreign exchange shock is gripping Central and Eastern Europe. As predicted by the stress test, the consequences are dire. Not only is unemployment too high, but it is also increasing, and GDP figures Europe-wide are reaching unprecedented negative levels. Now the question is, are the banks fit to face this scenario?
Banks now are safer, they have higher capitals, 7 times more capital than in the past. In that scenario, we can be sure that the banking sector can continue financing the economy in a proper fashion. The crisis has been terrible, but you come out of the marathon with less fat and more muscle. And more muscles mean that you are better prepared, you have less risk, you have better control risk, and you are better prepared to face another marathon.
But even if banks prove to be up to the challenge of supporting the 2016 time machine scenario, some changes may still be necessary.
I don't think we'll have in any way anything related to a solvency crisis or to a large banking crisis. But profitability obviously will suffer. We will see further consolidation. We will see coming up 3, 5, 10 at the most large European banks, really European banks with offices and branches and operations all across Europe or across the Eurozone. And then we'll see more national banks which will operate as the regional banks in the US.
Still with us is Piers Haben. Piers, let's pick up on the fact that 2 key elements were left out of the test. You've got sovereign default and deflation. A lot of critics are asking why.
A stress test can only have one scenario. We were asked to include deflation Ebola, Ukraine crisis. We couldn't include everything.
But deflation is a scenario that we're coming face to face with now.
When we designed the scenario last year, we wanted to see what would happen to banks when their loans went bad, and that can happen in inflationary environments, in very low inflation environments, such as the one we tested for. However, there are other parts to the bank's balance sheet that do need to be looked at specifically for prices going up and prices going down. And that's why the stress test isn't the end of the story for supervisors' work.
Taxpayers will be wondering, are we going to look at another bailout? We don't really actually have a funding plan if something goes wrong.
That's what resolution planning is about, so that banks can exit the market without the use of taxpayers' money. First of all, you must try and raise private capital. Secondly, you should use the existing capital. Resorts to public funds are as a last resort.
But is the resort still there?
Our intention is to avoid any use of public money, but let us also not pretend that we don't need to have some sort of fallback plan. State aid rules are in place for direct recapitalisation in banks to break this link between sovereigns and banks. But let us be very clear, we're not only talking about changes in the offices of who does supervision and resolution, we're talking about potentially money from governments. This is politics, this is European citizens, and those things need to proceed at a pace which is agreeable with the citizens of Europe.
What about resolution? Did we miss the boat in 2014? Are we going to regret that in 2016?
We need banks in order to serve the real economy, but it's also important that if a bank's business model is non-viable, that it's able to exit the market without disruption, and that is what resolution is about. What we think is important in the European Banking Authority is that we set rules now so that there is an effective resolution plan agreed in advance. In 2016, if the pace of change continues, we will be in a much better place than we were in 2011.
That's a wrap from the Real Economy team. Thanks for watching. Goodbye.